Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Warner Music Group Corp. Quarterly Report. Warner Music Group Corp. offers a wide range of businesses and services in the music entertainment industry. At its core, the company operates through two main segments, recorded music and music publishing. Under these segments, Warner Music provides various services including the discovery and development of recording artists, marketing, promotion, distribution, sale, and licensing of music created by recording artists. The company also markets its extensive music catalog through compilations and reissuances of previously released music and video titles, as well as previously unreleased materials. Additionally, Warner Music owns and acquires rights to approximately 2 million musical compositions, comprising various genres such as pop hits, American standards, folk songs, and motion picture and theatrical compositions. Warner Music operates primarily through a collection of record labels, including Asylum, Big Beat, Canvasback, East West, Erido, FFRR, Nonesuch, Parlophone, Reprise, Sire, Spin-In Records, and Warner Classics and Warner Records Nashville. The company markets, distributes, and sells music and video products to various channels such as retailers, wholesale distributors, independent labels, distribution centers, ventures, retail outlets, online physical retailers, streaming services, and download services. Overall, Warner Music Group Corp's businesses and services encompass a broad spectrum of the music industry, from artist development and marketing to music publishing and distribution. Unfortunately, I do not have access to the text you provided. However, I can still provide a general essay on what might cause a stock price to drop. The stock price of any publicly traded company can fluctuate due to various reasons. One major factor is financial performance. If a company's revenue and profits decline, its stock price may also decrease. This could be due to increased competition, poor management decisions, or external market conditions. Another reason for a declining stock price is changes in the industry or market trends. For instance, if the music streaming industry experiences a downturn, Warner Music Group Corp. Might suffer as well. Additionally, regulatory issues or legal problems can also negatively impact a company's stock price. Furthermore, investor sentiment and perception play a significant role in determining stock prices. If investors lose confidence in a company's ability to generate returns, they may sell their shares, causing the stock price to drop. This can be triggered by various factors such as poor earnings reports, leadership changes, or negative news coverage. Lastly, external economic conditions like recession, inflation, or interest rate changes can also affect a company's stock price. If these conditions are unfavorable, investors may become risk-averse and sell their shares, leading to a decline in the stock price. In conclusion, there could be several reasons why Warner Music Group Corp's stock price has dropped slightly over the past year. It is essential for investors to stay informed about the company's financial performance, industry trends, regulatory issues, and external economic conditions to make informed investment decisions. Warner Music Group Corp maintains a market capitalization of $16 billion, broadly in line with the industry peer group. Warner Music Group Corp trades at a higher price-to-earnings ratio of 54 times and a higher price-to-book ratio of 22.28 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. Investor should evaluate if the stock is worth its premium price. The company exhibits a very high leverage profile, with liabilities accounting for 92% of total assets. This elevated debt level warrants heightened caution, as it may limit the company's financial flexibility and increase risk during economic stress. We have to further examine the industry and the nature of the business to determine if they justify the current valuation. Average liabilities have increased consistently as the company expands. Importantly, both assets and shareholder equity have grown at least 20% faster than liabilities, indicating that the business is expanding substantially and generating value after covering its obligations. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The company have a dividend yield of 2.47%. The income statement shows that the company have been growing its revenue annually, and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth or decline in the music industry can be identified through various factors. On one hand, revenue growth is driven by digital revenue from streaming services such as Spotify and Apple Music, expansion into new digital distribution channels, increased adoption of emerging technologies like AI-powered music discovery, diversification of revenues through expanded rights deals with recording artists, growth in international markets, and music publishing's digital revenue growth from musical compositions embodied in recordings distributed in streaming services. On the other hand, revenue decline is attributed to physical revenue decline, artist services and expanded rights revenue decline, licensing revenue decline, and performance revenue decline. The recorded music segment experiences a significant physical revenue decline of 8%, while the music publishing segment remains relatively stable, with no significant decline mentioned. Overall, the industry's shift towards digital platforms has led to both growth opportunities and challenges in terms of revenue generation. The net income of the company decreased by $65 million, from $241 million to $176 million. This decline can be attributed to several factors, including a significant increase in depreciation and amortization costs, as well as unrealized losses on foreign-denominated loans and currency forward exchange contracts. Furthermore, the net gain on investments also decreased, contributing to the overall decline in net income. On the other hand, non-cash impairments decreased, which had a minor positive impact on the company's financials. In terms of profit margins, the company experienced a significant decrease from 14.4% to 9.6%. This decline can be attributed to various factors, including rate regulation limiting profitability, intellectual property litigation, digital piracy threats, and restructuring activities not generating expected cost savings. Additionally, high leverage has impacted the company's ability to raise capital and meet its obligations, further contributing to the decrease in profit margins. The significant amount of cash required to service indebtedness has also put pressure on the company's financials, exacerbating the decline in profit margins. The company's financial performance indicates a significant improvement in its ability to generate cash from its core operations. The net cash provided by operating activities has increased substantially, reaching $440 million in 2025. This represents a notable increase of $108 million compared to the previous period, demonstrating a positive trend in the company's operating cash flow. This positive operating cash flow is a significant indicator of the company's financial health and stability. It suggests that the company is able to generate sufficient cash from its core operations to meet its financial obligations and invest in growth initiatives. As a result, investors can have confidence in the company's ability to sustain its business model and achieve long-term success. The company's debt level and interest expenses have undergone significant changes in the recent period. In terms of debt level, there has been a notable increase from September 30, 2025 to December 31, 2025, with the total long-term debt rising by $6 million. This increase is attributed to various factors, including the acquisition of new assets and investments. The leverage ratio, which measures the company's ability to meet its debt obligations, has also increased significantly. Regarding interest expenses, there has been a substantial rise in the past year. Interest expense, net, has increased by 22% from $37 million in 2024 to $45 million in 2025. This increase is due to various factors, including higher borrowing costs and changes in the company's debt structure. The total interest expenses for the 12 months ended December 31, 2025 were $170 million, a 6.3% increase from the previous year. Overall, these changes indicate that the company has taken on more debt and is paying higher interest rates, which may have implications for its financial stability and future performance. Management's outlook for the company is one of transformation and growth. They are redefining their role in the music entertainment industry by focusing on digital music and taking strategic actions to accelerate this process. This includes reducing capital and overhead expenditures, which will help drive cost savings. The company believes that existing and new digital businesses will be a significant source of growth, and they are well positioned to take advantage of emerging technologies. To support this growth, management is entering into expanded rights deals, enhancing artist services capabilities, and expanding music publishing operations. In terms of liquidity, management is confident that their primary sources will be sufficient to support existing operations over the next 12 months. They are also taking opportunistic steps to extend maturity dates and reduce interest expense. Overall, the company's strategy is focused on driving growth through digital transformation, cost savings, and strategic partnerships. With a strong focus on intellectual property business through music publishing, management is optimistic about the company's future prospects. The company has a history of rewarding its shareholders through both dividend payments and share buybacks. In terms of dividends, the company has consistently paid out significant amounts to its investors, with $100 million being distributed in 2025 and $94 million in 2024. This demonstrates the company's commitment to returning value to its shareholders. In addition to paying dividends, the company has also engaged in share buybacks, purchasing a total of $28 million worth of shares in 2025, $26 million, and $2 million in 2024. These actions not only boost shareholder returns, but also help to reduce the number of outstanding shares, potentially increasing earnings per share for existing investors. Concerns about inventory buildup and supply chain disruption. There are valid concerns regarding inventory buildup in the current supply chain management. A recent analysis reveals a significant increase in inventories, with a notable rise of $2 million in 2025 compared to the previous year. This substantial growth in inventory levels raises questions about the efficiency and effectiveness of the supply chain. The accumulation of excess inventory can lead to several issues, including increased storage costs, reduced cash flow, and decreased product freshness. Furthermore, an overabundance of inventory can also indicate potential supply chain disruptions, where manufacturers may struggle to meet demand due to stockpiling or inefficient distribution channels. To mitigate these risks, it is essential for companies to reassess their inventory management strategies and implement more agile and responsive systems. By doing so, they can minimize the likelihood of inventory buildup and ensure a smoother flow of goods through the supply chain. That concludes the financial summary for Warner Music Group Corp. Feel free to comment below, and I will be happy to answer them when possible.